we formed the first partnership 50 years ago, 2 days ago, Thursday, on May 4th, 1956, which was 105,000. That's my sister clapping. She was in the partnership. We would, if Charlie and I were starting all over again and we were in this, Charlie would say we shouldn't be doing this, but if we were to succumb to Satan and engage in same kind of activity, we would, I think, be doing something very similarly. If we were investing in securities, we would look around the world and we would look at a Korea, and Charlie says you can't find 20 of them, but you don't have to find 20 of them. You only have to find one, really. You do not have to have tons of good ideas in this business. You just have a good idea that's worth a ton occasionally. And in securities, we would be doing the same thing, which would probably mean smaller stocks. It would mean smaller stocks because we would find things that could have an impact on a small portfolio that will have no impact on a portfolio the size of Berkshire.
Many investors today are working with small amount of capital, and many are just starting out. Warren Buffett, one of the richest people in the world and the CEO of Berkshire Hathaway, operates on a completely different scale. With vast resources at his disposal, Buffett often finds it challenging to invest in smaller stocks. Instead, he frequently opts to acquire entire businesses, as he did with companies like Nebraska Furniture Mart and See's Candies, both of which thrived under his ownership. But even Buffett started small, just like many of us today. The real question is, what did Buffett do differently in his investing strategy that has placed him among the top 10 richest people in the world? Buffett in his initial days emphasized investing in smaller and mid-cap stocks with high growth potential. He often recalls how in the early days he owned only few stocks, sometimes even just one. At the start of his career, Buffett focused on buying extremely undervalued stocks, paying little attention to fundamentals. His strategy was simple: buy them cheap and sell them once they reach their intrinsic value. Buffett has always had a natural talent for investing. With a deep understanding of undervalued stocks, balance sheets, and the complexity of businesses, he also grasped both micro and macroeconomic impacts on companies early on. For retail investors like us, it can be challenging to analyze a business with the same depth and insight that Buffett demonstrated in his early years. Instead of chasing cheap stocks like Buffett, we should focus on mid-cap and small-cap companies that are market leaders, have growing earnings and strong balance sheets. It's wise to avoid cyclical stocks like those in the auto and commodity sector and instead concentrate on industries like consumption, financials, and technology. If you're investing ₹1 lakh, it's better to focus on just 2 high-quality stocks. This approach can provide a better opportunity for overall higher returns on your portfolio.
I think if I'd been running a partnership a couple of years ago with a small amount of money, I think I'd have probably been 100% in Korea. And, I would be looking around for something that was very mispriced and that I understood. And every now and then that's going to happen. Charlie?
Well, I agree with that. The concept that you're likely to find just one thing where it'll make 20% per annum and you just sit back for the next 40 years, that tends to be dreamland. And in the real world, you have to find something that you can understand that's the best you have available. And once you found the best thing, then you measure everything against that because it's your opportunity cost. That's the way small sums of money should be invested. And the trick, of course, is getting enough expertise that your opportunity cost, meaning your default option, which is still pretty good, is very high. And so the game hasn't changed at all in terms of its basic arithmetic. And that's why modern portfolio theory is so asinine.
It really is, folks.
Yeah. When Warren said he would have been all in one country, that's pretty close to right. He wouldn't have quite done that when he had the partnership. But he would have been way more concentrated than is conventional if you listen to modern portfolio theory. Most people aren't going to find thousands of things that are equally good. They're going to find a few things where one or two of them are way better than anything else they know. And the right way to think about investing is to act thinking about your best opportunity cost.